With this time around, all eyes on the central bank, are they going to take steps to stimulate the sluggish economic growth in their policy review on Friday, the 7th of February? Given the fact that for the last 11 consecutive meetings, the rates have remained unchanged and we did see a rate cut in 2020, what is going to be the expectation? With new RBI governor at the helm, all eyes on whether or not we are actually going to see a policy rate cut this time around for the first time in almost 5 years. Madan Sabnavis, Chief Economist at Bank of Baroda, joined in to decode just that. Weak growth expectations, declining inflation and fiscal prudence in the budget. What are you penciling in from the Reserve Bank?
Actually, it's a fairly different kind of a situation which we have today. Because if we go strictly by the textbook, when I say textbook, if you go back to what was the mandate for the MPC, it was to singularly target inflation at 4% and keep it within the band of 2% either ways. So today when we are deciding on the repo rate, we should remember that all the inflation numbers which we have today in front of us, that is like starting from December and going back another 3 months, inflation has been above 5%. So it's going to be a kind of a tricky call which has to be taken by the MPC. But given the fact that two of the members in the last policy had already voted for a rate cut on grounds of saying that, look, inflation is something which is going to come down, it's being caused on the food side, and there could be certain pressures on growth. Therefore, there was a justification for lowering the repo rate. So if you fast forward to today, when the MPC sits down, they're still looking at high inflation, but prospective inflation is likely to be lower. Going by the RBI's projection, it's going to be less than 5%. So this could give them some kind of comfort that there could be a case for cutting the repo rate. So two things have happened here, Avan. One is that we are talking in terms of liquidity, which was very tight. And last week, the RBI had announced a number of measures to ease liquidity. And what we see today is that the deficit in the system has come down. And I do think that as we go closer towards 7th, the system will normalize. And the second thing which we have seen is that the budget has been fairly pro-growth, which means that from the point of view of this fiscal stance, there have been measures taken to ensure that there will be a bit of pickup in the overall GDP growth rate to consumption and investment. So this being the background, I think there's a very high probability of the MPC voting in majority to lower the repo rate when they meet on 7th.
Sure, and Madan, given that there are expectations that there could be some tinkering with CRR as they did last time, is that something you're working with?
See, in my view, I think there may not be any action taken on CRR. And I'll give you the reasons for it. Last time when the RBI did lower the CRR, it was very clearly mentioned that it was taking the CRR to the position it was in prior to the Ukraine war. So therefore, it was a case of normalizing the CRR. Subsequently, we have seen that the measures which the RBI has used has been a part of their new liquidity framework, which is using primarily the VRR auctions to induce liquidity in the system. And last week's announcements, we have seen that they've used a combination of VRR, they've used the buy-sell swap, that's on the forex side, and they've also announced open market operations. So when we have more dynamic instruments to induce liquidity as and when it's required, and quite interestingly, I think on the 7th, the day of the policy, there's going to be a 56-day VRR, which means it's going to last right until the next policy. So it looks like that it will persevere with these measures rather than going for a CRR cut.
Do you think that, Madan, we could see alteration in inflation and growth forecasts?
Okay, in terms of growth, personally, I feel that 6.6, 6.4, there's not much to choose. And the 6.4% number which the NSO came out with is likely to be revised upwards. We should remember that when the first advance estimate is announced in January, you have information practically for only 8 months. And 8 months of the year with another 3 months to go, taking a call on 6.4%, which is based on extrapolations, based on past trends, as well as data which is available up to 7 to 8 months, is normally susceptible to change, more likely in the upward direction. So even the February number may not be very much different, but I'm quite sure when we come towards May, we would have a number above 6.5%. Now, this being the case, I'm quite sure that the Reserve Bank of India would also be reworking the models, because we should remember that most of these numbers which come out are based on modeling which is done, which has a number of assumptions, number of variables. So to my mind, there could be some kind of a downward revision from the 6.6% number which was projected earlier. The important thing will, of course, be what kind of a call is taken on GDP growth for 25-26. Because here, the government of India, that is through the economic survey, they're talking of a range of 6.4 to 6.8. Will the RBI probably be a bit more specific? Because I think psychologically for the market, anything above 6.5 may be considered to be good. Anything less than 6.5 could be just about stable and bring it on par with what it was for 24-25. Now, in terms of inflation, I think it's unlikely to be any change for 24-25. Again, the important thing will be that what will be the conjecture going forward for 25-26. In fact, for 24-25, we have read about certain heat conditions in the north. So we're not quite sure if the Rabi crop could get affected. So as of now, going purely on the basis of sowing, it does look like that we'll have a good Rabi crop and food inflation will be less of a concern. It's going to move in the downward direction. But we'll have to wait and see towards March, April. I think that's the time when you normally get the harvest, whether these assumptions really hold or not. So I think the important thing will be that the forecast for the coming year, because that will give us some idea about how many more repo rate cuts could be there in calendar 25 and probably for the full fiscal 25-26.
Sure, Madan, let me get in your take, because fiscal prudence could keep, the fiscal risk low this time around. What is it that you're working with in terms of monetary policy and the linkage of fiscal?
See, as far as the linkage between monetary policy and fiscal policy, I think it largely comes from the fiscal deficit. And I think here the government has been fairly steadfast in sticking to its goal of reducing the fiscal deficit ratio. We should remember that this particular ratio had gone up during COVID time when a lot of fiscal stimulus was provided by the government, and this was necessary given the conditions. And since then, there has been this decision to roll down the fiscal deficit ratio to 4.5% for next year, which has been done already. And I should think that it's probably will be targeting around 3% in the next 3 to 4 years, depending upon how things pan out. And this being the case, I think the critical part is that the government has also ensured that the net borrowing program remains slightly lower than the previous year. So I think the goal is to also reduce the net borrowing program so that the kind of pressure which we see on liquidity is something which is eschewed. So given this, that the fiscal deficit 4.4%, the net borrowing program 11.5 lakh crores or so, it's not going to be a major concern for the Reserve Bank of India when it's looking at monetary policy. So the RBI can look just at the trade-off between inflation and growth, though inflation is the primary target. But if to the extent that growth becomes a consideration, they could be looking at it, knowing very well that the government is not actually imposing itself on the liquidity situation by controlling the fiscal deficit ratio and accordingly the net borrowing program.
And then, Madan, of course, we've got the rupee and dollar equation. The fact that the dollar has really been gaining strength against the currency back home. What is the sense that you're getting with Donald Trump at the helm now?
See, it's going to be very hard for one to actually pinpoint a particular number about where the currency will end up, because we have seen there's been a lot of volatility in the rupee ever since Donald Trump came to power. And after he's been sworn in, I think after all the articulation at the time of elections, he has actually started bringing action in the sense that he said he's going to impose higher tariffs on Canada, Mexico, China. Some of it is already on the way. There's a pause button certainly for certain other cases. There's been some kind of a retaliation which has been spoken of by Canada, will probably also be done by China and Mexico. So in this kind of a situation, we could be expecting the rupee to be very volatile. Now, if you look at the rupee, actually, there are two sets of factors which affect the rupee. One, which I would call fundamentals based on inflows and outflows of dollars. Here, I think the rupee is fairly well balanced, but it's the external factor. As we see the dollar index strengthen, and that's what we have seen since Donald Trump has actually taken over in January 20th or so, that the dollar has been strengthening. As the dollar index keeps strengthening, we see all the currencies have been taking a hit. And we actually did an exercise to see that if you only look at what is the external factor at play, what should be the ideal rate of the dollar, even after we adjust for inflation, relative inflation of India with the countries which are included in the NER for the RER. And we found that probably a rate of around 87 per dollar would be a fair rate to take care of this ideal kind of a situation. But this said, I think there has been a lot of intervention by the RBI, both in the spot market, forward market, NDF market. So they're trying to make sure that there's not excess volatility in the market. At the same time, the RBI has been a bit more flexible when it allows the rupee to depreciate. So to my mind, 86.50 to 87 would be a fair enough range provided we get more clarity on what Donald Trump is going to do. Because right now, I think there's a lot of noise factor in the market. What he does to Mexico and Canada may not be affecting India directly, but there was some talk that India could also be included. And I'm sure there are negotiations going on. Some of the custom tariffs which have been lowered are more pragmatic, and that's something which could also be placating the other global players. So, to my mind, 86.50 to 87 would be a fair enough range, but it could be any kind of volatility right now based on these daily developments which are taking place, based on what America could be doing or what they could be doing.
And Madan, do you think that in the February meeting going forward for the year ahead as well, are there chances of further rate cuts? What's the trajectory according to you?
I think the commentary at this particular point of time will be very well balanced. I don't think it's going to be dovish. I don't think it's going to be hawkish. It's going to be more cautious. So I don't think the stance is going to be changed. There could be some action on repo. There could be some measures announced for liquidity, not the CRR, but on the other counts. But given the fact that the global situation appears to be fairly fluid, I think there will be a lot of caution also which will be expressed, because currency may not be a direct part of monetary policy action, but definitely be a part of the commentary, because when we're talking of risk factors, because I think that is very important, the external sector, what really is happening. And while a weaker rupee could translate into higher imported inflation, I wouldn't like to overstate the case saying that it could lead to very high inflation, but definitely maybe around 0.2, 0.3% is definitely possible. And this is also more on the conservative side, because today what's happening is that even if crude oil price goes up or the price goes up because of a weaker rupee, I think there's a lot of protection which is being offered at the retail end, that those prices haven't really changed. So I think it will be a case of the burden sharing between the government and the OMCs. That's something which we carry on. So therefore, I think the overall the view will be very much balanced. There will be a lot of caution exercised on account of the global situation. No major concerns in terms of the domestic economy, because I think lots of those which we had, like consumption, private sector investment, have been partly addressed by the budget.
Right, gentlemen, it's been a pleasure interacting with you. Thank you so much for joining in and sharing with us your expectations from the Reserve Bank.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.